A true fortune is never built by taking wild risks or constantly chasing the latest trends. Most everyday investors focus on quick profits, but the true secret to long-term wealth lies in defending what you build. In the competitive world of business, capital always flows toward high profits, attracting aggressive rivals. Without a strong defense, even a giant company can see its cash flow vanish. This core challenge is why Warren Buffett built his vast empire on one single idea. That vital strategy is known as the economic moat theory. Imagine a profitable enterprise as a grand castle built on a flat plain. If that castle generates great riches, rival armies of competitors will inevitably march across the field to take its wealth. A strong economic moat acts as a wide barrier around that castle. It keeps aggressive rivals away and lets the owner charge profitable prices year after year without losing ground. To see this powerful principle in real life, we must look back at one of the most famous trades in history. In 1988, Warren Buffett made a bold move through Berkshire Hathaway. Many financial analysts were confused when he began buying massive shares of Coca-Cola shortly after the stock market crash. While others saw a simple soft drink maker, Buffett saw a business with a massive shield that no rival could cross. The landmark Coca-Cola 1988 investment proved that a real moat goes far beyond simple brand name recognition. It is fundamentally about pricing power and deeply ingrained customer habits. Coca-Cola did not need to lower its prices to survive aggressive competition. Millions of consumers around the globe bought that red bottle every single day because of a deep habit and a global delivery system that rivals simply could not duplicate. When a business lacks a strong economic shield, rival companies quickly copy its product and force prices down. In a free market economy, high profit margins act like a bright light that attracts eager competitors. New players enter the market, offer cheaper alternatives, and squeeze profits until nobody earns a strong return. Without a wide defense, high earnings fade fast, leaving investors with declining assets and lost capital. Warren Buffett understood early on that true wealth creation requires compounding high returns on capital over decades. If a business loses its protective wall, that compounding process stops dead in its tracks. Therefore, building lasting wealth is not about finding fast growth, but finding businesses that can protect their high return on invested capital. The durability of the defense matters far more than the temporary excitement of a new product line. One powerful form of defense comes from high switching costs. When changing to a competing service costs a customer too much time, effort, or money, the original business gains deep customer lock-in. Consider a specialized software vendor that manages a hospital network. Even if a rival offers a minor discount, replacing the entire operational system is far too disruptive, forcing the customer to remain loyal and pay consistent prices. Another major economic advantage comes from a permanent low-cost structure, enabling a company to undercut market prices while earning steady profits. Consider the famous Geico acquisition completed by Berkshire Hathaway. Geico operated on a direct model, selling vehicle insurance directly to drivers without relying on expensive physical agent networks. This created a low-cost engine that established competitors could not easily copy without destroying their existing sales models. The strategic Geico acquisition demonstrated how a low-cost advantage creates a self-reinforcing wheel of financial strength. Because Geico spent far less to acquire and serve each driver, it could consistently offer lower insurance premiums. Lower premiums attracted millions of new customers, driving unit costs even lower. That steady flow of premium cash, known as insurance float, provided Berkshire Hathaway with billions of low-cost capital for long-term investments. Many modern investors fall into the trap of funding fast growth without evaluating long-term security. They place their capital into high-flying startup companies that burn millions of dollars just to acquire temporary market share. Yet if those new users can walk away at any moment without penalty, the underlying business holds no structural equity. Real wealth belongs to those who back businesses with deep structural defenses before market downturns strike. A third major defensive pillar is known as the network effect. This dynamic occurs when a platform or product becomes more valuable as more people join it. A single telephone line has no utility, but a global network connecting millions of people is indispensable. When an enterprise operates an expanding network where every new user increases utility for everyone else, competitors face an almost impossible task trying to rebuild that scale. When a business allows its defensive barrier to shrink, structural decay can happen rapidly and quietly. Executive management teams may grow lazy, or emerging technological shifts can render legacy systems obsolete. As competing firms cross those weakened lines, pricing freedom vanishes. The company must spend huge sums on marketing and discounts just to hold on to existing customers, causing overall return on equity to collapse over time. History is filled with tragic stories of once great companies that failed to preserve their defensive advantages. Berkshire Hathaway itself originated as a struggling New England textile manufacturing mill. Warren Buffett learned a painful personal lesson while trying to turn around a weak industrial operation that lacked any economic pricing power. That early business struggle permanently reshaped his investment mindset toward buying high-quality businesses with unassailable marketplace positioning. Rather than attempting to fix broken businesses, Buffett redirected his energy toward acquiring wonderful companies at fair prices. A weak business absorbs capital like a dry sponge, constantly demanding expensive equipment upgrades while yielding low returns. Conversely, a high-quality business with a wide economic moat operates like a financial engine, producing abundant excess cash year after year with very little extra capital required to maintain operations. This distinction between capital-intensive businesses and capital-light enterprises reveals the true mechanics of financial leverage. Companies protected by deep economic moats possess the rare power to raise prices during inflationary cycles without driving away customers. When prices rise, profit margins remain intact without requiring massive spending on new factories. Consequently, a broad protective moat serves as the ultimate hedge against rising operating costs and market volatility. Developing a moat-focused perspective transforms how you view stock market price movements. Daily price fluctuations on a trading screen are merely temporary noise driven by market emotion. The true underlying reality is whether the business is expanding its competitive moat day after day. If a company's structural advantages are growing stronger, short-term stock price declines are simply rare opportunities for disciplined value investors to build equity. Intangible assets such as legal patents, government regulatory licenses, and famous brand reputations represent another formidable defensive layer. A broad patent portfolio grants a firm legal protection over its unique inventions for years, while regulatory licenses restrict new competitors from easily entering the market. When these unique intangible shields are paired with capable management, a business can sustain high returns on capital across multiple business cycles. However, investors must recognize that not all popular brand names create a genuine economic moat. If a famous brand name does not allow a company to charge higher prices than generic alternatives, that brand possesses no true economic power. True moat strength is measured by pricing power. If an enterprise can comfortably raise prices by 5% without losing market share, it possesses a real financial shield. Consider how Berkshire Hathaway systematically constructed its vast collection of stable insurance, railroad, and utility assets over several decades. By taking the reliable cash flows generated by early triumphs like Geico, Warren Buffett acquired businesses defended by permanent structural shields. Each strategic addition to the portfolio expanded total cash flow, reinforcing the overall conglomerate against major economic shocks and long-term market shifts. The contrast between speculative investment strategies and moat-focused capital allocation is striking. Speculative capital often chases short-term trends in unproven industries where low barriers to entry invite endless competition. While a few early players earn temporary profits, Many collapse once cheap capital vanishes. Sustainable wealth accumulation demands predictable long-term cash flows, protected by enduring competitive advantages that stand firm against aggressive market rivals. To evaluate an economic moat with precision, you must carefully study a business's return on invested capital over a full 10-year period. If a firm maintains high returns on capital year after year without relying on dangerous debt leverage, it almost certainly controls a broad protective moat. That steady track record of elevated returns serves as concrete empirical proof that rivals cannot easily duplicate its business model. Building enduring wealth requires the mental discipline to ignore emotional market trends and focus on underlying fundamental strength. Most market participants fail because they lack the patience to let quiet, high-quality businesses compound capital over extended time frames. They trade away solid long-term compounders in pursuit of speculative returns, ultimately risking their core principle. True financial success is achieved through the disciplined accumulation of durable business assets. When analyzing any corporate investment, you must always ask what stops a wealthy rival from launching a competing enterprise tomorrow and stealing market share. If the answer relies on hope or temporary speed, the position is vulnerable. However, if the answer rests on proprietary networks, massive scale advantages, high customer switching costs, or legal barriers, you have uncovered a durable enterprise capable of long-term wealth protection. The lasting success of the Coca-Cola 1988 investment, alongside the full Geico acquisition, stands as historic proof of this disciplined philosophy. Decades after those initial acquisitions, both companies continue to generate vast cash returns for Berkshire Hathaway. These businesses did not require risky operational pivots or constant speculative reinvention. They simply defended their established market positions while allowing long-term compounding to build staggering wealth over time. While technology and modern consumer habits evolve rapidly, the fundamental economic principles governing competitive advantage remain constant. Ambitious competitors will always attempt to erode high profit margins whenever opportunity exists. Your responsibility as an investor or business leader is to continuously monitor whether your portfolio assets are expanding their defensive moats, ensuring their pricing power and capital returns remain secure against future competitive threats. Ultimately, achieving financial sovereignty depends on acquiring superior businesses protected by permanent economic moats. By prioritizing long-term competitive durability over short-term speculative hype, you align your capital with the unstoppable force of compounding returns. When you focus on building and owning wide structural defenses, time becomes your most valuable strategic partner, securing a prosperous legacy that endures across generations.